Well, considering purchasing your first home and don't really know where to start, the home buying process can be complex, especially for new buyers. So, in this segment of Making Sense, Forest Area Federal Credit Union mortgage loan manager Jody Perkins guides us through the entire process from how to build your credit to how to get pre approved or pre qualified and the do's and the don'ts when it comes to buying your first home. And if you have any questions tonight, you can just shoot us over in the comments section here and we'll address them with Jody. Jody, thanks so much for joining us. All right, let's walk us through the mortgage process. How do you get from pre-approval to closing? What's that process like, especially for that first-time buyer? What do they need to know?
So the first thing that I always talk about is you need to establish credit.
Okay.
Credit's really important in the mortgage world, or in any industry for that matter, from anything from your car insurance to home buying. And to establish credit in the mortgage world, we talk about having at least 3 trade lines. So trade lines are items on your credit report, and we look for at least 12-month reporting history. So yes, paying things off early is great, but at least 12 months of payments. So why is credit important? Because it shows responsibility in making payments. It shows us how well that you can handle making those payments, and it shows us how well responsible you are in using the credit you have available to you. Many times with credit, we look at needing a certain credit score to qualify for certain programs.
Okay.
Typically, we look at a 680 credit score. Some programs go as low as 580, but they're a lot more detailed, a lot more information is needed at the lower credit scores. It also affects your interest rate. So credit's very important in that world, in our world.
So, Jody, let me interrupt you there. So if somebody is watching this at home and thinking, I'm not sure my credit score is where it should be. Okay. Is there a number ballpark where instead of maybe thinking about buying a house, they should be working on their credit for 6 months or a year or something like that? Is there a pivot point where, okay, I got to do this first before I should consider doing that?
So I tell people when they come in, if they haven't established credit, it takes about 12 months to get it established.
Okay.
So looking for those 3 trade lines for the 12-month payment history. If they don't have credit, it's doing secured credit cards, secured loans, small credit cards. Credit cards are huge in boosting credit score because about 35% of your credit score is capacity, or how much credit do you have available to you versus how much you're using. So that's typically where the direction that we had put people in to get credit established. If you have some troubled debt history, making sure that you stay on time with payments going forward. If there are collections out there, making arrangements to get some of those paid, or reviewing your credit report. So there is a website called annualcreditreport.com.
Okay.
I just read that they can actually pull their credit. You can pull your credit report every month. It used to be you could pull one credit report a year per credit bureau, and it is now monthly since COVID. So that gives you the option to look at your credit report and see what's on it, to give you an idea of what things need to be improved.
And it sounds like, if I'm understanding what you're saying, if you have good credit or a slightly higher credit score, not only may have more options when it comes to your mortgage, but your mortgage, if you get a better rate, that's going to cost you less for the length of that loan. So either having good credit or improving your credit situation, your credit score situation, could really save you significant money, I imagine, over however long your mortgage is, right?
Absolutely. A 1% difference is a huge in your payment. It's, depending on the mortgage loan amount, it can be anywhere from, $100 to a couple $100 a month, which in the term of the loan is a lot of money.
That adds up quickly.
It does.
Yeah. All right. So you have your credit score. Let's say you've worked on it, or you've established credit, or you've gotten it up to where it's a little bit better. And so you're thinking like, okay, I can move forward with this. All right. Let's talk down payments. What technically is a down payment, and how much is required? What should we be shooting for before perhaps we may be ready to actually buy a house?
Sure. So traditionally, a down payment on a mortgage is 20%.
Okay.
And it's 20% of purchase price or appraisal value, whichever is less. So
Okay.
sometimes in the market being increasing like it was a few years ago, the appraisals weren't keeping up with the purchase prices. So there was larger down payments. So 20% is a traditional down payment. There are programs that are as low as zero down. Um, Typically, you still have some money out of pocket for some closing costs, the appraisal, some of those inspections, those kind of things. But looking at 20% as low and as low as zero. Again, credit score plays into that, income plays into that, um, and other factors is time on job. Lots of different factors can come into that as well.
And so ultimately, if you have money for a down payment and you put down 20%, you would basically be getting a mortgage for the remaining 80% of the purchase price.
Correct.
Okay. So if you put down more over the same, this is going to get confusing. I know it, but I'm thinking out loud here. Okay. So if let's say the length of the mortgage was the same length and the rates were the same,
Mhm.
if you're borrowing less money, your monthly payment is going to be less, correct?
Correct. Hmm.
So the more you can put down, the less you're going to be paying theoretically every month for your mortgage payment, right?
Yes.
Okay,
That also
awesome.
plays into if you put the lower down, so anything under 80% requires what's called PMI or private mortgage insurance.
Wait, under 20%?
Under 20%
Okay,
down.
okay.
Yes.
And okay,
So
so what is PMI?
private mortgage insurance is a program that allows people to get into the home with less than 20% down.
Okay.
It's an added insurance premium to the mortgage every month until you're under 80% loan to value. If you make improvements to the home, if values jump, sometimes it can be removed earlier, but it's usually on there for at least 2 years, or until you're under that 20%. Or,
And the person taking out the mortgage pays a little bit for that, correct?
yes. Yes, and it can be expensive depending on the higher loan to value. So the less you have down, the more you're paying in PMI.
But once you cross, and I'm thinking out, I'm just
Hmm.
trying to, once you cross that threshold where you have technically, I guess, more than 20% into the house, the PMI, you no longer, that gets removed.
Correct. Yes, it automatically will fall off at 78%. So once
Oh,
it's in this built into the system, when you're under 78% loan to value,
okay.
that will automatically come off the loan. In most programs, there are a couple programs that do require it for the life of the loan.
But PMI does give the person, the home buyer, prospective home buyer, the opportunity to maybe get into a house without having a 20% down payment with where house prices are these days. So 20% is
A lot of
still
money.
it's a lot of money. There you go. You said it. Yeah. Okay. So we do during this segment we talk about a lot of things, and one of the things we talk a lot about is pre-approval and pre-qualification. Before you fall in love with the car, the house, or anything, I know what you can actually afford. So when it comes to mortgages, what is pre-approval and pre-qualification?
Yes. So if you're not quite ready to buy and want to figure out where you're at, that's when you're looking for the pre-qualification. It's a conversation with the loan officer, maybe doing a soft pull on your credit report, so it doesn't actually do a hard pull or a hard hit on your credit score. Talking about income, talking about time on job, figuring out all of those things, and figuring out what you can afford. Um, with mortgages, we have to include student loan debt into their payment, into their history. So if you have student loans, even if they're not in a repayment, we do require, or we have to incorporate 1% of that balance as a payment into your debt ratio. So that's can be challenging as well. So that's another thing that we talk about when the pre-qualifications. On a pre-approval is when we do a full pull on the mortgage, on the credit. We also get 30 days pay stubs, last year's W-2s, potentially tax returns. We gather all of that information and make sure that we can get you qualified.
So is the process, typical process, you get pre-qualified and then you go through pre-approval?
Yes. So pre-qualified is getting you the letter to look at the house.
Okay.
Pre-approval is once you get the everything back to the loan officer. It's just a little more in depth. So
Okay.
it depends on the company which one they offer you. We do both. Most of the time we do a pre-approval. We do the full income and verification and all of that. So it depends on the underwriter. It depends on the mortgage company, which way they go. If you're doing it online, a lot of times it is the pre-qualification because you're not submitting that information to the underwriter. So then sometimes it can be challenging when you get to underwriting that you now have to provide a lot of information.
Yeah, what kind of information are we talking here?
Making sure that the bank statements, that we can prove that you've had down payment. If you have to have money out of pocket, the down payment has been in your account for at least 60 days, that there are not any charges on your bank account. So anything like your monthly payments to Amazon or your Affirms and those kind of things that don't report to credit, but show up on your bank statement, those also have to be included in debt ratio. You hear me using the word debt ratio a lot. That is very important in the mortgage world, as the federal government after 2008 had set a limit of 43%, including, like I said earlier, the student loans. It also includes property taxes and homeowners insurance on any property that the potential buyer owns. So if it's a purchase of a second property, we have to include both properties in that. So there's lots that plays into debt ratio in our world, and that also can play into your pre-approval process.
When do we, as a potential buyer, when does the pre-qualification, when should we go through pre-qualification? Do we come to you and we're like, that house, that's the one I want, make it happen, Jody? Or should we do that early on so that we have a better idea of the range that we should be falling in love with?
I like to see people come in early and have a plan.
Okay.
Doesn't mean that people don't come in and be like, I want this house. How am I going to get it?
Right. Yeah.
I like it better if they come in early and we talk about what they can afford to make sure that their dream home fits their budget. Or if it doesn't, how do we get them there? What things they need to change? Do we need to wait for interest rates to come down? What things make a difference in their situation? It could be they've been on their job 9 months. Maybe we need that extra 3 months to be able to prove how long they've had it. If they're self-employed, having 2 years job history. I have to have 2 years tax returns on self-employment and be able to prove income from that tax return, which can be challenging. So it's making sure that we have all of that information and getting everything there.
Jody, one of the reoccurring themes that we have in many of these topics, especially when it's buying something big, is people people are like nervous to come in and pre-qualify because they don't want to be like, this is what I make and this is the house that I want to get. And you guys have dealt with, this is what you do. You help people chase their dreams or modify their dreams if they should be chasing something a little more realistic. This is what you do. People should be reaching out to you because you guys can help walk them through and navigate them through this process. Is that right?
Yes. So if there's credit issues, we have a partnership. The credit union has a partnership with GreenPath. So we can help, we can get you over there. We can help make recommendations on how to get better on your credit. What things maybe should you pay down? At tax return time, maybe you can put some of that money away towards a down payment. We do a lot of suggestions that way too. So if you're almost there, but not quite, what things can we change? Or I'm just starting out and I don't have a whole lot of credit. Where do I start? So we do everything in all processes. We do all sorts of borrowing. So never be afraid to come talk to us. Yeah. If you are more comfortable to, chatting online, putting an application in line, all of those resources are available to anybody as well. So, that gives you a little bit of that distance from having that face-to-face conversation that can be difficult for people, especially if they're in a challenging situation. The other side of that is if you're in a situation and need help figuring out where to go, talk to us. And that's, we talk to people every day from the first-time home buyers to I'm ready to lose my house. How do I get there? So don't be afraid to come talk to us. We are familiar with situations. We may not always know the answers, but we are here to help you figure out where to go.
Well, in the very least, this may be the first time that somebody is buying a house for the first time, or the first time that somebody is perhaps in a pinch, but it's not the first time that you have help people navigate through this. So if you're scared or nervous about that, go talk to other people that do this for a living. They can
Yes,
certainly
absolutely.
help you out. Yeah. All right. So what are some things, and I'm sure you've seen a lot of them. But what are some things that we should not do when trying to buy a house?
Yes. Don't make any big purchases. Don't
Okay.
apply for credit. Um, don't switch your job. That's a big one too.
Yeah, wait, well, let's put a caveat to that. Job X is going to pay me double. What does somebody do in that situation?
Wait.
Really? Really?
Really, if you
Because
are especially if you're in the process of buying and like already have a purchase agreement signed, wait until you have signed the mortgage and everything is closed. At that point, you can make that job change. Um, so I have to have a minimum of 30 days pay stubs. So you start a new job, you're waiting another 30 days. So yes, even though you're going to make more money, wait.
wait.
So don't make any big purchases. Don't switch your job. Don't open or close any new lines of credit. Make sure you make all your payments on time, because even though I pull your credit in the beginning to get you pre-qualified, it may get pulled again before you close. So make sure that you're
Mm,
not
mm.
reestablishing new things or out there pulling, because it does happen. Um, don't let anybody else pull your credit. It is okay to shop around. Credit pulls do affect credit score. It also says that you're looking. So having other places pull your credit, again, for credit cards, even places like your store credit cards, Best Buy, Walmart, Sam's Club, all of those types of things, report to credit. So we show those credit pulls on the credit history. And then we have to explain whether or not you got new credit, and if you did or didn't, and if you have new payments. All of those kind of things have to be explained in writing. Don't make any large deposits into your bank account. And this one
Yeah.
seems a little bit.
No. This one, it was on my radar when you said it earlier, and I was like, I'm going to circle back with Jody to explain why suddenly that you constantly had $3,000 in your savings account, and then suddenly before you go for your pre-approval, you have $63,000 in there. Why is that? Why is that problematic, or can be problematic?
So the mortgage world, we look for what's called seasoned funds. So funds that have been on deposit for at least 60 days. Anything that's a new deposit or larger than a normal deposit has to be sourced. So I have to say where that income comes from. And if you got it from a loan, then I have to be able to document that loan, or whether or not you have a payment. Did you get it from a family member? Okay, where did they get that money from? Sometimes it's a couple step process. So if they are gifting you funds for closing, that's okay. But we need a letter stating that they're gifting you those funds, and you don't have to pay them back. So making the large deposits is just a trigger.
Right.
Any financial transaction, we're always on the lookout for fraud.
Sure.
So that's really what we're gearing for, is making sure that there isn't any fraud out there.
And so it sounds like, correct me if I'm wrong, but it's kind of like flossing after we go to the dentist, and I'm going to explain why. Okay, we're all on our best behavior, right? To get to that pre-approval or that pre-qualification. But it sounds like, much like the dental hygienist will tell you, we should continue that good behavior of keeping an eye on our credit, not all those things that we were on, that financial diet. We keep on that financial diet and those financial good patterns and behaviors until we're in the house, right?
Mm-hmm.
Just because
Yeah,
you don't want anything to
exactly.
derail this.
Yes,
And
because it's not clear until the day that you sign that paperwork. So everything is not final until the day that the mortgage is signed. So up until that date, anything can be withdrawn. So it's always important to make sure that you keep everything as clean as possible. Document things as if you're doing them, or if you have family members giving you funds, make sure that we're keeping track of those. It's all about
all right. So
keeping
those are
everything
the things we shouldn't do. I imagine that every so often you come across a young home buyer that comes in and you're like, wow, that young man or young woman had their ducks in a row. So what are the things that they do that you're like, oh, like this one, this is how I would tell a loved one to do it. Do it like Kate, or do it like Bob, or something like that.
Yes.
What are some of kind of those characteristics or traits that you're like, boy, that's the way to do it?
Yes. So my first thing is establishing credit. We've talked about that a little bit. So making sure that you establish credit, getting those 3 trade lines out there, getting the 12-month history.
Mm-hmm.
That's the very first step. The second step is saving money towards a down payment. So having a minimum of about $7,000 typically is what I suggest, so that you have the money for not only the closing costs, but potentially moving in, because that can be expensive too. You want new furniture, or you need a new rug, or all of those
Snow
kind of.
shovel, or all those things
Yeah.
that the landlord took care of. And yes, no, that you spend more time at the hardware store and the appliance store in the first month moving into a new house than you ever imagined. So yes,
Yes.
totally.
Yes. So having some funds on deposit so that you have that fall back on and have some resources. And then having some time on job, not job hopping. Um,
Yeah.
we look for that 2-year history on jobs as well. So having, if you are a job hopper, that's totally okay. I just have to source every single job that you've been on within the last 2 years. So we may have to call and verify employment with all of those people. So I really like to see a 2-year job history, or at least a year in the same history. So if you went from ABC company to XYZ, but they're the same type of company, you still work in a plumbing company, that's great. Just like to see that change. So at least 30 days on that job in the same industry, at least 12 to 24 months. And then just having an idea of what you can afford. So
Yeah.
I can approve somebody up to 43% debt ratio. So a debt ratio is how much of your monthly income goes towards your monthly debt. So we take up all your debts that you pay that report to credit. So your car payment, your credit card payments, student loan payments, all of those things. We add those up, your monthly payments, and divide it into your monthly gross income and come up with a ratio. I am looking to keep your mortgage under 43%. So when I tell people, okay, you can afford X amount of dollars, I don't know how you spend your funds. So that's something we talk about too. I don't know if you eat out every day. I don't know if you're at the casino 3 times a week. I don't know what you do. So have an idea of what you can actually afford.
Yeah.
And what
In that debt ratio, so if we're talking about a first time home buyer, I assume they're living somewhere. And if they're not living rent free at home, is rent part of that debt? Is that considered, like, that's an expense, but is that considered debt?
It is not in this case. So
Okay.
it does, we can use that towards payment history. So if they've rented from someplace for at least 12 months, we can use that as a debt that they've paid. We do have to document that information, but it is not included in their debt ratio.
Okay. All right. Very good. Is there anything else you want to add, Jody?
So I think just kind of going through the process. So you get pre-approved, you find your house, you do a purchase agreement. Typically that's done with a real estate agent. You can do it on your own, but we suggest it with a real estate agent, especially on a first-time home buyer.
Sure.
Then we do a full application.
Okay.
So making sure that all of the disclosures and stuff are signed, provide any remaining documentations. Once we have all that back, we order the appraisal and title work. And then once I have all of that back and everything is clear and the value is good, it goes to underwriting. Underwriting looks at all of the documentation we've gathered and says we may need other things, or things might be needed clarification on the appraisal. Once that is done and they give me a clear to close, we can set up closing. There is time frames with all of these things. Paperwork has to be done within certain periods of time. And then at the closing table, which is typically at a title company, they will walk through about 100 pages of documents and get your mortgage signed, and then you're a homeowner.
Then you're just running to buy shovels and hangers.
Yes.
And throughout this entire that process, to me, I bought a few homes. That process to me is like, ooh, that can be overwhelming. For the first time home buyer can be overwhelming, which I think stresses all the more importance of talking to you, having an ally in your financial institution that can do the heavy lifting that maybe you don't need to be involved with, or explain the process to you. Doing this by yourself for a lot of people can be overwhelming to the point of maybe a little analysis paralysis, a little crippling. And where do I even start? But if you go in and you talk to your credit union, talk to them about, is there somebody here that can help me help explain this, but also help me navigate? The answer, Jody, is going to be,
Come talk to us. We're here.
there you go. There you go. It's that easy. Hey, Jody, thank you so much for clarifying this. Hopefully some of the folks watching feel a little bit more empowered and can take the steps necessary to get the keys to their first home.
Yes, we're excited to help you.
Thank you, Jody.
Thank you.